How would this 3.8% surtax affect American taxpayers? Joining us is Laura Saunders, who writes the tax report in the Wall Street Journal. First, Laura, let's reiterate how this tax works. It's a flat surtax, isn't it?
That's right. It's a flat surtax, 3.8% on net investment income. That's after losses and things like that. And it takes effect for single people at $200,000 of income and married couples at $250,000 of income, which sounds like a lot, but it can reach somebody who's more middle class if they have a windfall from a one-time sale of inherited stock or a piece of land or something like that.
So it was supposed to be a tax on the richest or very rich people, but more people apparently will end up getting hit by it?
Well, that's right. It's still 3/4 of the tax, more than that, is paid by people with incomes above $1 million. So it does mostly hit very rich people, but it can reach way down. Also, these thresholds, these income thresholds are not indexed for inflation. So it sort of catches more people every year.
Now, you give an example. The 3.8% levy applies only to the investment income above this threshold for single married filers, and I believe you have an example in your column.
Yeah, I do. Say you had a single person who had $180,000 of income, and it was all from investments. There would be no tax on that. But say then this person sold some stock that they held for a very long time and had another, say, $50,000 of income. Well, $30,000 of it would be subject to the tax. That's because the amount over the threshold is subject to the 3.8% tax. Normal retirement income isn't subject to this tax, like IRA distributions and pensions, but they can raise your income so that any investment income you have is subject to the tax if you go over those thresholds.
Laura, what counts as investment income?
Oh, well, it's a long list, but it's very familiar items. Mostly interest, bank interest, dividends, capital gains, and certain other things. What doesn't count as investment income is muni bond income, and also often investment income if you actively participate in the business, like if you rent houses and you have rental investment income, but you meet the definition for active participation. It's not subject to the tax.
I'm speaking with Laura Saunders of the Wall Street Journal, and you're listening to Your Money Matters. Thanks for listening, everyone. Laura, you say that high earners may not be able to avoid the 3.8% surtax, but others can often minimize it through planning. How so? Give us some tips.
Yes. The most important thing is to look out for a spike in your income. If your income is going to spike because of a one-time event, selling land, selling long-held stock shares, things like that, think before you sell and see what you could do to, say, split the stock sale into 2 years, December and January. Now, another thing that's really important to say is that this is not going to apply to the sale of most homes. People get very upset about that. There is a $500,000 exclusion of profit. The first $500,000 if you're a couple, or $250,000 if you're single, of profit on your home is not subject to this tax because of a special law. Now, if you live in San Francisco or New York and you're going to have a bigger gain than $500,000, you need to think about the tax. But most home sellers really don't need to worry about it.
And you say a person should harvest losses. What do you mean by that?
Well, one of the nicest things is that you can take a loss from one thing, like stock, and use it to reduce a gain from something else, like selling land. It's quite nice how that can work. And so, you need to harvest losses, keep income low where you can. Just be aware that if you think you're going to have a spike in income, think about this in planning in November or before you sell the asset, not after the end of the year.
Another tip that you list here is hold until death.
Yes, that's a solution for many problems, right. I suppose. And if you hold an asset till death, there's no capital gains tax on it and no 3.8% investment income tax.